In this video, we will be talking about the differences between a 15-year fixed and a 30-year fixed mortgage. And obviously, the most apparent difference off the bat is the loan term. So let's look at some pros and cons real fast, and you'll notice that they're basically just going to be the opposite here. So, pros of a 15-year fixed: you will pay down more principal upfront because it is a shorter loan term, so you have to pay it off faster. And they're generally speaking, they're going to have a lower interest rate there, so you'll save some money on interest. Cons: since you have to pay it off faster, you will have to make larger payments month by month. And because it's a higher payment, they will be harder to qualify for this mortgage. So when you look at the 30-year fixed, we are looking at pros. It's just the opposite again. We're going to have a lower payment because it's paid off over a longer period of time, and that makes it easier to qualify for. And the cons is you have a longer loan term, but again, the flip side of that is you get a lower payment. And then also you get less principal paid down up front, which I'll show you what that looks like. And it ties back to our earlier video about amortization. So I have a couple trending graphs here to show you guys so you can see what it looks like when you're paying the principal portion and the interest portion of your total payment. So for a 15-year fixed mortgage, our yellow line here shows the interest portion really going down over the life of the loan, which is what it does. But the green line is principal. As you can see, you're going to start paying a significant portion of principal up front, and it actually overtakes the interest sooner in the loan than a 30-year might. So if we look at a 30-year graph, it looks more like this. The yellow line is the interest, so you're paying a more significant portion upfront, and it's more than the principal for a longer period of time. In the 15-year, the principal outpaced the interest by about year 3. Here in the 30-year, it's going to take us a lot longer, more like 20 years or something like that to outpace. But again, it's going to be paid down over a long period of time. Your total payment will be lower overall. So I'm actually going to exit out of this real fast, and I want to show you just this example here. This is going to be what we look at for a couple scenario breakdowns: 15-year fixed, 30-year fixed. What we're looking at, what I'm based this graph off of, is this $700,000 purchase price, 20% down. This is what roughly the margin will look like between a 15-year and 30-year. This is all, of course, just for education. It's hypothetical, but just to give you an idea of the difference in rates and what it can be, here's the difference in payments. So shifting your loan term to a 15-year term basically increases your payment by about $1,000 in this case. That'll vary by total loan term and rate. And we're also seeing it doesn't really affect down payment or cash to close there. But just to compare the principal and interest payments there, it's the same difference basically. So $4,600 to about $3,500 there. And I'm going to pull up that old Excel sheet where we originally looked at amortization. And here is the 15-year term, as you can see there. Off the bat, we are starting with almost $2,000 being paid towards principal. And again, you want to see more green here. You want to see more money paying down that loan balance and added to your equity. So if we scroll through that, and again, we'll see the interest go down as well. Scroll through that, it's going to end at month 180, which just passed it, but it's right there. So you'll see that reflected in the graph as well. And here's the 30-year. So it's a difference of about $500 a month in principal, right, that we're starting at. And it takes us a lot longer to overtake that interest and just to pay down the loan in general, scrolling down a lot more. So back to that, we started at $500 in the 30-year, and it looks like, where did we start at? Just about $2,000 in the 15-year. So again, saw those pros and cons. It's interesting to compare the options there. You can do any loan term from 10 to 30 years. So it'll really just depend on your specific situation. So as always, let me know if you want to price out your own scenarios. I'd be more than happy to help you out. And if there's any other questions or videos that you want to see, of course, let me know that too. All right, thank you folks, and have a great one. Bye-bye.